Right, let's get that on. Good evening, everyone. How are we? Hopefully, everyone is fine. Hopefully, you can hear me clearly as well. Just let me know if you can't. Um, yeah, I've got everything set up on my side right here. How is everyone? How has everyone's week been? Let me just get that through here. How's everyone's week been, guys? I know that Food Dweller asked if you're on here already. Thanks for joining GT Playboy. I can see you're on here as well. Christine, welcome. Good evening. Thanks for joining. So, look, apologize in advance. Obviously, well, last week we spoke a little bit about Bitcoin and crypto, and we kind of focused a little bit on that. I didn't really get to take as many questions as I would have liked to last week. And I'm also obviously bearing in mind time. Um, Actually, I do have a question for you guys, and I do need to maybe run a poll on this. Is 9 p.m. still okay for everyone for me doing these lives on a Sunday evening? Because I'm aware that obviously people have work on a Monday morning. But when I asked this whilst we were still in the middle of the pandemic, people said, yeah, because obviously kids are in bed and it allows you to kind of focus on things, but you didn't have to get up to go to work per se if you're going to an actual location, an office location. So is 9 p.m. still okay? Do let me know. Because yeah, if not, we maybe need to look at some alternative time because I'm aware that this often goes an hour, an hour and a half. That means we're then approaching 11:30, which is well 10, half 10, almost 11 o'clock sometimes, which is pretty late. So what I might do is actually just put like a poll in the community tab and just ask people to complete that really, just so I can get a good consensus as to what time will work best. But Marky, I can see you're on here. Spencer, I know you're saying 8 o'clock there. GT saying 9 p.m. Yeah, we'll run a poll so we can establish whether it's a good time or not. All right, so what I'm going to do is just literally just jump straight into these questions and see how much we can get done in the next 57 minutes, maybe a little bit more if we have to go for a little bit longer. Snuggles, how you doing? All right, so let's have a look. So, hi Pete, is it wise to invest in an S&P 500 fund and a Nasdaq 100 fund at the same time? There's no reason why you can't. There's no reason why you can't. I mean, the exposure will be a little bit different, but there's no reason why you can't pick both, as long as you have good reasons for picking both. Obviously, why are you picking the Nasdaq and the S&P 500? Is there a particular reason for it? Why you want exposure to both and maybe not one of the two, in opposed to both of them? There'll be good reasons for having both, but what are your reasons? I mean, it's really because obviously this is a personal kind of like take and something you need to consider for yourself here. You know, why do you want exposure to the two things? So can you get a little bit of exposure from one that you can't get from the other? That will be the main thing. And obviously just acknowledging that, right now, Jerome Powell and the whole talk about interest rates last week was a little bit of it's a bit of a farce in my opinion. He's told us that rate hikes are coming in March, but he's not told us by how much. And I think for the US markets, S&P 500 and Nasdaq, that's a really important piece of information that is missing and has intentionally been left out, because I honestly feel as though they don't really know what they're going to do just yet. What's going to happen, and I'll place a bet on this, is they will get to March, they'll see how bad inflation is, and then they'll decide how much they're going to increase the rates by, whether that be 0.25%, which is what they've been signposting, or 0.5%, or even more than that. We don't know. And the S&P 500 and the Nasdaq will be susceptible to that. So as long as you're happy with the fact that there's still quite a lot of unknown out there, then yeah, by all means. But yeah, what are your reasons for wanting exposure to the two of them and not one over the other? Oh, by the way, let me just do some shameless plugs to start off with, actually, whilst we're here. Issue 2 of the Convo is going to be out in 2 weeks' time. It's going to be on a weekend. It's going to be on a Saturday. I'm aiming for the 12th of Feb. So that is my new magazine. It's monthly. There's going to be a lot of commentary in there around markets, inflation. We're going to be looking at crypto specifically against the backdrop. Do the fundamentals actually stack up? We're going to be looking at that. So if you're not already on the subscription list, I strongly encourage you to go over to the website conversationofmoney.com, and you can subscribe on the homepage, the first banner as you land on that page. Put yourself forward. The emails will go out on the weekend of the 12th of Feb. So if you want some other kind of like content that you can consume and just read through and maybe get more about the way I'm thinking about things that hopefully will help you think and gather your own thoughts, then that may be a really good approach, something for you to subscribe to. So make sure you do subscribe. Claudio, how you doing? Naeem, what's going on? My week was hectic, mate. If I'm completely honest. Thanks for asking. Yeah, it was absolutely nuts. Next week is the calm before the storm. We have some shoot dates now, which starts on the weekend of the week of the 8th, or the beginning of the week next. Well, it's the week beginning the 7th. So we're shooting 2 days that week, and then we've got shoot days for the rest of February, pretty much into early March. So things are about to get very, very, very busy indeed. So yeah, it's exciting, but at the same time, a lot of prep work to be done for it as well. So my hours have almost I can add on another literally 5 hours to my day in terms of work that needs to be done straight off the bat immediately right there. So yeah, it's exciting, but a lot of work still. Ralik's on here. How you doing, Ralik? Thank you. Cheers, Ivan. Appreciate you. Thank you very much. Thanks for the value that you present. Thank you very much. Yeah, January. January's almost gone. We're going to be in February in a couple of days' time. I'm just trying to go through everything sequentially, guys. So give me 1 second. Abdul. I have two questions. One, when investing in the US platform Stake, do you still pay stamp duty? Two, do they offer any ETFs, or is it just stocks? Um, Stake, Stake does have a suite of ETFs on Stake, so you can access ETFs with them. You can't access. There were some ETFs that you can't access because of a piece of legislation. So I'm trying to remember what it is now. Bear me 1 second; it will come back to me. There are some that you can't access. I'm trying to have a look at this on my phone actually whilst we're here. You can definitely get stocks with them for sure. But on ETFs, you can get some ETFs. I'm just trying to figure out and just find out where you actually go, because they had a little bit of a revamp of their app recently. Right, so let me just do a bit of a search on here. Let's do S&P, because you will be able to access that, I'm pretty sure. Yeah, so things like ProShares Ultra, you can access that. That's an ETF. You got the ProShares, you got the SPSXX, you can access that. Some UK ones you cannot access, though. I know that for a fact, and that's due to a piece of legislation. In terms of stamp duty, you shouldn't be paying stamp duty on the ETFs, as far as I can recall. Because on UK stocks, you're going to pay some stamp duty on UK stocks. I can't remember whether you shouldn't pay them on US. I'm pretty sure, but I might have to double check that for you, mate. But yeah, you can access ETFs with Stake specifically. But there are certain ones that you cannot access because of a piece of legislation. I can't remember what the piece of legislation is now. If it comes back to me later on, I'll mention it for you. This is a really good question. One question: how do I build a discipline not to withdraw any money from an ISA which I use for a long-term investment fire fund, basically? Right. So this will be a take. It's all about trying to segregate your accounts. So if you've got, and I don't know the situation, right? So I don't know whether you have the ISA account available on your phone, or whether you have, what are your methods of accessing that account or seeing that account? How is it visible to you? Because one of the easiest things you could do is literally just not have either the app or any accessibility to it visible to you, period. But that's a practical tip that you could easily implement if you just delete the app, right? But you may need to, if you're doing it for the long term, if you want to monitor it and stuff like that, you may have to re-download the app every quarter, every 6 months, every year, or whatever that is. But limiting the access to it. But beyond that, just in terms of practicality, I'd be asking you, so why are you accessing and withdrawing from that money? That would suggest to me that maybe you haven't got your budget down that much. So really try to get your budget down. And when I say get your budget down, it's understanding, right, if you've got this much coming in, you're allocating X into your ISA for your fire goal, right? So that's one thing. Then you're allocating money for, your food shop and, miscellaneous, the things that you like doing and everything like that. When I say get your budget down, I mean try to make sure that you aren't kind of leaving yourself too short, so that when you are short, you then have to go and access the ISA account. And that may mean that you have to kind of like adjust your approach. So for example, if you're putting in, I don't know, 50 quid into the ISA every single month, okay, if you reduced it to 40, will that make it a little bit more sustainable for you? So you're not undoing the hard work that you're not undoing the work that you're doing at the minute, putting money into the ISA. So maybe sit down and just have a look at, over the last 6 to 12 months, how much have you been taking out of that account? If it's been something that you've been doing on a regular basis, if that is an actual amount, reduce your contribution into that by that amount. And then hopefully that will give you a little bit of balance. There are a lot of people who try to, throw money into specific goals, right? And they're like, I'm going to put money here, and I know that this money is going into for this particular purpose, and it feels good at the time, but because they haven't got enough balance within their existing financial situation, they never keep up with it. And when I do coaching, that's one thing that I always say to people: balance is absolutely key. It doesn't matter whether you're putting 50 quid away or 30 quid away, you're putting something away. Yes, you're going to know that you're not putting enough in terms of the compound effect. The compound effect will be greater for larger amounts, but there's no point in committing to a larger amount every single month if it's not sustainable. If you're going to keep taking away from it, you might be taking some money out when the markets are down and all that kind of stuff. It's really, really important that if you're able to set this kind of like goal and that plan on tracks, that you can just set it and forget it, never have to really touch it. So that's what I'll suggest. Try and get down to your budget. Make sure that you've got it nailed down, really, really nailed down. If you need to reduce how much you're putting into that ISA every single month to give you a little bit more room on the financial side from a month-to-month basis, do that. But also the app, if it's an app that you've got, any access points you've got to it, delete them. Don't make them readily available to you, so that you feel the temptation to basically use it. I say this to people who have credit cards. If you have a credit card and you've paid it off, you did the balance transfer, what you often do is you keep the old credit card. And I've done it before. Balance transfer the credit card. 2 months later, I'm back into that credit card that I just did a balance transfer from. So now you're doubling up on your debt. Get rid of the card. Get rid of the temptation to be able to use it. And I think hopefully that will help, mate. But a couple of things for me there. Yeah, Naeem, I like this. Okay, this is a good one. I watch a program called The Decade the Rich One, featuring Gary Stevenson. If you have watched it, what are your thoughts? Quite insightful. The company's dodging corporate tax around 2011. Yeah, I did watch it. It was really, really interesting. The thing that I took from it is there are a lot of parallels. There were some parallels between where we are right now and where we were back then in 2007, 2008. So when they introduced things like quantitative easing, which is what's coming to an end right now, which is one of the factors that is essentially sending the markets into a spook. Remember, the whole idea of quantitative easing is the government prints money, pumps that into the markets to keep asset prices buoyant. That's been going on since COVID. America was printing $120 billion a month. They're tapering that back by $30 billion a month at the moment. So when you combine the fact that there's not a lot of money going into the markets to sustain asset prices, inflation, interest rates. All of those factors are in this cauldron where we're seeing all this volatility and potentially market correction to the point where we see the asset prices correct. I see that parallel with they actually did that in 2007, 2008. They didn't know whether it was going to work or not. And I guess it was very, very interesting to watch and hear Gary's kind of take on it. I knew it was kind of like that because I heard stories of, yeah, we just came out of a financial crash and we knew that we got here because there was stupid amounts of like risk being taken. And I heard because when I had friends in Canary Wharf and I was working in Canary Wharf, you would have conversations with people and be like, oh, what was it like back then and all that kind of stuff. And you would hear that they were being told like, go hard or go home. And you think, hang on a second, we've just been bailed out. And now you want us to double down on that risk and take even more risk. It's the way the financial industry works. And it works like that because ultimately, traders, they're not trading with their own money. They're trading with bank money. And it's always kind of that equivalent of you're going to make some losses. So you got to be okay with that. Hopefully the profits that you make will cover the downside of the losses. It's a very, very insightful, really, 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 really good program. If anyone hasn't watched it, I think it should be available on Player or something like that. Definitely go back and watch it. It's very, 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 very interesting. And it's just a shame to see that I really question, have we learned anything? Did we really learn anything from back 2007, 2008? Or are we just repeating the same thing with a little bit of process compliance that has made the system slightly more stronger, but still with the vulnerabilities that we had back in 2007 and 2008. Right, Cami. I'm a new investor, just wanted to put some of my savings into investing, but was looking for something very low maintenance, so started using Nutmeg with a social responsible ISA. Okay. Have I done anything obviously wrong? Am I missing anything obvious that I should have done instead? Well, you've got into an ISA, so that's good. You've chosen a provider, so you've chosen Nutmeg, which is good. It will be low maintenance because they'll do all the work for you, so that's fine. Nutmeg are very good because they do have a process that walks you through kind of like your risk profile. So you'll be invested in a manner that suits the answers that you gave them. So I think you're in good stead there in terms of what you've done. I mean, look, there isn't really much you could do there in this particular scenario that could go wrong. You've basically outsourced it to a company that has will have a team full of professionals, like a very large team of professionals looking at the market, trying to make the calls on your behalf. So you're trusting their skill set and you're trusting what they do to put you in the best position. If you were completely new and you had no idea about the market and you were asking this question, having tried to pick your own index fund or ETF, then we'd be having more of a conversation around risk profiles, how long you're looking to invest for, your plan, all that kind of stuff, your goal. But because you've outsourced it, all of that is going to be taken care of by Nutmeg. So you're pretty sweet, really, to be honest. I think you've done the right thing there, especially if you wanted something that's going to be very low maintenance. They'll take the hurdles and jump all the hurdles for you. Really good choice, actually. It's good. Spencer, I keep hearing the S&P is a good stock. I'm running with VWRL. What's your thoughts? What do you mean? What do you mean? S&P as in the market or S&P the stock? Because those are two different things. S&P 500, the market, is different from S&P the stock. So which one do you mean, Spencer? Let me know, and I can circle back to this. Alex. Hi, Pete. Ask you a question in the comments of one of the videos on Friday about your opinion on the life strategy 100 to 80 versus the FTSE global market cap for investing in the long term. Yeah, I think I told you to come here on today to actually answer the question. Really, really good that you're here, mate. Okay, so let me have a look. I might need to do a screen share, so bear me 1 second. and I'll try to. I've got this plugged in at the moment because I was going to illustrate some bits and pieces when appropriate. But let me just find. Let's go onto the Vanguard site, and I can share my screen with you. And maybe we can have a little look at it together. How about that? So the first thing you need to know about the life strategy funds is they are funds of funds. So basically, it's a fund that holds a load of funds in them. So with that, it means that you're going to have different investment vehicles within there, which can aid with diversification, essentially. Let me just... okay, I need to get rid of this screen, and I need to pop up a new one to share my screen with you. 1 second. All right, this might be a little bit narrow. Let's get rid of this for the time being. See if I can extend this so you guys can see it properly. Let's go here as well. Okay, cool. All right, so if you're going into life strategy funds, which is this one right here, and I think you're in the 80% one, right? So you're right here. So this one has got, let me just go back quickly. This one has got 80% in equities, 20% in bonds, right? Go back. Yeah, so you're in this one right here. Cost point 0.22, which is pretty good. Risk profile 4, which is scored out of 7 with Vanguard specifically. Okay, so you've got 80% equity, 20% in bonds right here. So this is a fund of funds. How do we know that? If we go onto the portfolio data here, these are all essentially index funds, unit trusts, index funds here. They're all funds of funds. So an ETF is still a fund. So within this fund are these basket of funds. Now, these basket of funds are globally diversified or globally invested. So here you're going to have the FTSE UK All Share. So this is the FTSE All Share. This will be the large cap, the mid cap, the small cap companies. Then in here you've got the US Equity Index. You've got the FTSE Developed World. You've got global bonds, right? Global bonds in here as well. Emerging markets. Then you've got, the FTSE 100, FTSE 250. So it's giving you a larger kind of exposure to the UK market, but then it's niching down into a certain part of the FTSE All Share. So now you've got 100 exposure, 250 exposure, as well as the overall share here. You've got the S&P 500. Now, obviously, these weightings are important. So, you've got a large exposure here to the UK All Share. Some people may say, actually, why have a lot in the UK right now? Many people argue that, actually, you know what, there's a lot of cost sensitive, or I would say stocks or companies that are being sold with a discount right now. So people would say it's a really good investment to hold long term. You've obviously got US in here, 19.2. Then you've got the developed world FTSE as well. What I'm trying to say here is you've got a mixture of all other kinds of Vanguard funds within the life strategy fund, 80%. So you've got great exposure to a number of instruments that Vanguard have put together. Now, when you compare that to the the VWRL you were talking about there, so you're looking at this one, and it's global, isn't it? Yeah, all world. You're going to be more concentrated in terms of how you've actually invested in this. Number one, you don't have any bond exposure, so you haven't got that counter lever on the risk side of things. This is 100% equity. The price point is still pretty much exactly the same. Was the life strategy 4? This is a 5, so maybe a little bit more in the risk because it's 100% equity. You've got 3,801 stocks in there as well, but essentially, when you go into, portfolio data here, you've got the geographical regions here where it's invested, but you can see the individual companies. Whereas because the life strategy fund is a fund of funds, you've got a mixture of all of their various ETFs and index funds, these ones right here, included in the life strategy fund. So in other words, if you want to look at it from a purely diversified point of view, you're gonna have quite a lot more diversification in the life strategy fund. That doesn't necessarily mean that it's going to perform better than the VWRL. I can't tell you whether it's the right thing for you to be invested in. That's really down to you to decide. But the two are very, very different. The two approaches are very, very different. You've got diversification with the number of funds that are inside the life strategy fund and bond elements. Whereas with the VWRL, you're going 100% equity, concentrated. Yes, you're going to have a more global approach, but it's concentrated in equity specifically. So I can't tell you whether it's the right thing, but hopefully that explanation has kind of helped you know what the difference between the two of them are, which I think is what your question was on the comment midweek. Oh, cheers for that, guys. Appreciate it. Thanks for answering my question last week, Pete. Very, very helpful. Someone did ask last week, by the way, how one would access the ARC ETF fund. So Kathy Woods. So the best way to access Kathy Woods funds that I know of would be to use eToro. They're all available on eToro. So if you are using eToro for your investments, you've got access to all of her ARC fund there. I just wanted to get the iPad back up there. Okay. Let me just come on to this comment right here. Okay. So I know that fees are a big conversation to be had here. I don't want to be leading anyone with fees. Sometimes I'm actually sick of hearing the argument about low fees. Low fees are great. But if you're in a situation where you don't know how to pick these things, you're not really confident around what to do when you're picking these things. If you're the kind of person that just wants to put money somewhere, you don't want to have to be looking at it, then fees are not part of the conversation, because you're paying for somebody's expertise to run an investment portfolio for you. If you have the expertise to do it, then by all means take it on yourself. Then yes, compare the fees. And another popular argument that you're going to get from other YouTubers here will be, well, if you invest in small amounts, you want to make sure that the fees don't erode what you're investing. Fair point. But do you know what you're doing? If you're going to put your money into something that you're not really too sure whether it's right for you, wrong for you, you haven't really got any kind of structure to whittle these things down, and you're doing research here on YouTube, and you're following fees as your selection criteria, you're on the wrong track. You're on the complete and utter wrong track. But if your priority is, I want to send money somewhere, I don't have to worry about it, I want to know that it's invested, I want to know that it's looked after, and I don't have the time to do it, you don't want to be reading financial news, you don't want to be having to decipher or worry about what Jerome Powell said and what that means for your investments and the stocks that you're holding, then do not worry about the fees. Focus on seeking a provider that has the expertise to be able to perform on your behalf. Even with Vanguard, which is the panacea of cheap providers, right? Because they are the cheapest on the market. Probably, well, you have the likes of Invest Engine, where you can actually get all of the Vanguard ETFs available now. And because you're doing it with them, you're not paying the platform fee, so they're a little bit cheaper than Vanguard now in that regard. But even if you're picking Vanguard, if it comes to the point where you have to make the choice of the investment vehicle, so whether it's the VWRL or the VUSA or any other investment vehicle, you have to know that it is your responsibility to monitor and make sure that you're in the right place. Because if you miss something, you don't pay attention to it, and you should have done something and you didn't, that's your bag. It is your bag entirely. So if you don't have the time, you don't want to be worried about, paying attention to that kind of stuff, then selecting the provider that can do it for you is the right thing to do, regardless of whether you pay fees or not. Forget fees. It's all about your personal circumstances. And I hate to burst people's bubble, because that's what everyone says on YouTube. Keep low cost. You should be investing low cost. You should be investing low cost if you know what you're doing. If you don't know what you're doing, then you're going to have to bite the bullet and pay a little fee to somebody. Cost is only an issue. Cost is only an issue in the absence of value. So if you're paying somebody a fee, what is the value that you're getting back? What is the return that you're getting back from them? So investment return. What's their performance been like? But more importantly, if it means that you don't have to worry about paying attention to the news or doing any analysis or, spending an hour or two every week or every other month, time that you could be doing something else. If that's the value that is given back to you, then by all means pay fees. Like, I know a lot about the stock market. I pay people fees to look after my portfolio, and I have a large portfolio. Why? Because even though I'm on YouTube and I talk about investing and I do have individual stocks, which I do monitor, I'm running a business. I don't have the time, neither do I want to be spending my days constantly looking at what I'm doing within my portfolio. For my large pots of money that are in my core satellite approach, I'm happy to pay fees. Some of them I'm paying over 1% on one of them. And actually, they performed extremely well for me. There's this myth being perpetrated on YouTube that fees, low cost is the best way to go. That is not true. It is absolutely not true. And particularly in times like this is when you're going to realize what the right options for you are. Money Farm, I've got money with Money Farm. They are still up. Despite the fact that the markets are down, they are still up for me 9%. 9%. Most people who have been in the S&P 500 would have seen their portfolios fall somewhere anywhere between maybe 5 or 10% in the last maybe month and a half. Money Farm is an actively managed portfolio. So they have people, a team of people who are looking after my investments for me. They're making calls on my behalf. They have access to information that I do not have access to. They will have analyst reports every single day. I am paying them a fee because I'd rather have them do that for me. So if you're just starting out, don't be fooled by this stupid fallacy that it's all about low fees. Yes, it needs to be considered, but it needs to be considered in conjunction with where you are and what your knowledge base is. And from a realistic point of view, do you have time to be looking at your investments on a day-to-day basis? That's really, really, really important. So just to park that, because I think it's really, really important. Bear me 1 second. There's a question with a super chat attached here. So bear me 1 second. Let me see if I can actually get to this, and I'll come back up in a moment. Thank you for the super chat as well, by the way, AA. Really do appreciate it. So, hi, P. Hope you're doing well. Just wondered, what do you think of staking stablecoins such as UST or USDT? There's some good APYs, and for my research, seems pretty good so far. You know what? This is a really, really, really good question. I'm actually thinking of doing a video because I've never staked or anything like that. And I was looking at crypto.com last week, and on crypto.com, you can get 12% APY. So one of the themes in the issue 2 of the magazine this month is going to be, well, with inflation so high, what you would typically do is you would look for a bank account where you could offset the impact of inflation. But inflation's at 5.4%. So the highest it's been for 30 odd years. So you're not going to get an interest-bearing account or high-yield savings account that can offset that in any tangible way, shape, or form. The other thing that you would do is what we talk about here on the channel. It's you would invest money into the stock market. But unfortunately, right now, with the news of inflation, interest rates, QE tapering, the markets are extremely volatile. It looks like we are heading into correction territory. So you've got increased risk on the investing side. So what are the alternatives? And one of the alternatives that I'm thinking of actually doing is documenting me actually staking some money in various places, maybe crypto.com being one of the bigger ones. I don't want to choose one that maybe, it's not as established, and having a look at that. But I know that the APYs on crypto.com are extremely, extremely attractive right now. You can get higher than 12% on some of them, but they just feel as though, for me, if you're offering something ridiculous, I mean, 12% is pretty stonking anyway. But if you're offering something like, I think I saw one for like 34%, then my question automatically goes to, right, so what am I risking in exchange for the 34%? So when I looked at it, 12% was kind of like the bottom end. So what I'm thinking of doing is actually just doing a video where I document actually putting maybe, I don't know, 5 or 10 grand into something like that to show the process of how they actually work. And I might explain a little bit about that in the actual magazine in issue 2 as well. But I'm having a few chats with people at the moment just to think about how we actually go about doing that, because it's not just as straightforward, I gather, as open account, send it over here. You've got to do certain things. So that will be something that I will be covering. Cheers for that, AA. Thanks for the super chat as well. Let's get back up here. Okay, so this one. If I had to choose one fund in Vanguard UK to cover the world, which one would you choose? Thanks, Alves. Look, I don't want to tell you that I would choose this because people will just go and buy that one thing. I don't like doing that here on this channel because I think ultimately that could be dangerous as well because my approach is not going to work for you. What I would pick may not work for you. I may say, actually, you know what, my situation has changed. I'm going to go completely low risk. So actually, I wouldn't pick one of those. I could be on the opposite spectrum. I'd be like, you know what, I'm full gun ho, high risk. I'm going to choose this. It necessarily won't work for you. I guess the premise of this story, of this question here, if I had to dig deeper and try and read between the lines, is if you want a world index fund or ETF, then your exposure is what you're going to be looking at. Number one, to sectors, and number two, to global, into like geographical regions, right? If you're looking at any of the global ones, most of them will be a good fit. But if you go into Vanguard, each of them will be tilted or built for a different kind of like objective. So therefore, if you're looking at the VWRL or any other ETF which is global, what you should do is pay attention to the objectives. So does it give you access to large cap, mid cap, small caps? Do you want access to small caps? If you do want access to small caps, there'll be one in there that is suitable for you. If you only want to ride with the large cap companies and the mid cap companies, then maybe pick one that has access to those specifically. All of the global ones are going to have a huge weighting towards the US, so exposure to the US. Are you happy with that? Are you not? I mean, look, what's going on with Ukraine right now? I mean, can America really afford to get into another war alongside NATO and the rest of us? Probably not. So if that does happen, hopefully it doesn't, but if it does all kick off in Ukraine, that's just another issue to add on to all of this stuff that we're experiencing with the market right now. So, we can get into the whole geopolitical conversation on another kind of like live, but there are so many levers and things that we have no control over. So, and you have to consider those things when you're trying to invest in the market. The question is, how do you reduce your downside as much as possible from a practical point of view? If you're going global, the question is going to be, do you want access to all of the large caps, so the big companies, which will be like the Apples of this world, Amazon? Do you want the mid caps, the guys that sit within the middle, so not necessarily in the S&P 500, but a little bit below that? And do you want some of the small caps, which may necessarily be, companies that are relatively new on the markets, but have great potential for growth? That will be the real question. I can't tell you I would pick this one because I don't want you to go and pick something that I say this will be the pick of the bunch, because that's not the right thing for me to do. And my outlook to the way I invest is going to be completely different to the way you invest. So it's the rationale and the understanding of how you pick these things that I try and impart on this channel, not necessarily to give you pick this. I mean, I'm seeing ridiculous videos on YouTube right now, which, to be honest, are completely dangerous. There was one the other day. It was talking about a stock will never, ever, ever be this cheap. And in essence, it was pile in and go and buy this stock right now. This is one to buy on the dip. You don't know if that stock's going to drop any further than it currently is. You don't know that. To say that is irresponsible. The person can say that and feel no certain way about it because, well, hasn't really worked in any investment management role in any way, shape, or form. Probably hasn't seen the impact of somebody that you work with quite closely have to deal with. My investments down 10 to 15%, and what that can potentially do for people's goals, and the impact that it can actually have. I have, which is why I'm very, very careful around saying this and saying that. I think more than anything else, the most imparting and most powerful thing that I could do is try to give you things to think about. So when you take those things in consideration, you can arrive at your own understanding based on further research that you might do here on YouTube. With record new investors joining the markets, is this evidence that overly generous COVID support schemes like furlough, etc., were not justified? Yeah, I mean, look, there is a huge argument for that, a massive argument for that. I don't think we saw a massive influx of investors purely because of furlough. I think we saw a massive influx of new investors over the last 24 months because of the situation of COVID specifically. people simply wanted their money to go a lot further. And the only way they were able to do that was by investing. And let's put it this way: look, I'm a massive, massive beneficiary of the pandemic and COVID and people being locked down. I mean, at the peak of lockdown, I was doing 150, 200,000 views a month. Like, my channel blew up as a result of COVID and people being locked down at home and not really having much else to do but watch YouTube videos. And you think about GameStop, GME, all of this kind of stuff happened then. Why? Because people had really nothing else to do. They weren't going to work. They had money. They were like, or they didn't have enough money and thinking, I need to make some money quickly. Guess what? They then come across content online, which leads them down the rabbit hole to channels like mine. And God forbid, any other channel out there that may not necessarily have the same morals that I have. I think it's a combination of just people being locked at home, not really having much to do, and ultimately knowing that they need their money to go a little bit further and looking for solutions to help make their money go further. And unfortunately now, if they come into it and listen to all the hyperbole that was around back then and is still around to a certain extent now, this market correction will be very, very painful because they've never, ever, ever been here before. All they were told was, you can make a lot of money. Now, if you're sitting on a -5 or a -3 or a -4, it's only natural that people start asking, well, have I done the right thing? Should I be getting my money out? So on and so forth. So I think it's a mixture of things, really. But I think COVID and the pandemic was, for me, in my mind, the biggest driving factor in it all. Yeah, Vodafone was mentioned in that documentary around the tax. And to be honest, this is what Gary talks about all the time. He talks about, certainly in circumstances where we are right now, where like we've got inflation running riot at this point in time, right? You need to get companies to pay their fair share of tax. It's how you go about doing that. I mean, just some of the numbers that were in that documentary were absolutely ridiculous based on the turnover or the profits of these businesses. It's mad. But, the HMRC making deals because they wanted the money in quickly. I understand why they would have done that, but it's just bad business practice. When you're desperate to receive money like that, of course you're going to cut a crappy deal. Of course you are, because you are looking for the inflows and you're willing to cut, people a break. And these companies will be more than happy to take, a massive discount on the tax they should have paid. Of course they're going to pony up. Of course they will. If you owed someone like 10 grand, he goes, oh, I really need money. Why don't you just give me a grand? Of course you're going to be like, yeah, I'll take it. Thank you very much. Same principle applies. Oh, Martin. Yeah, thanks for this, mate. Thanks for this question. You know what? I was really surprised. Out of for the 2 years, 3 years this is the third year. All the time that I've been doing YouTube, that has been the lowest viewed video that I've done, and it's probably the one with the most important message of all. And I don't know. Am I disappointed in the view numbers? Yes, because ultimately I would have loved to have had people actually help try alert Instagram to this, and this is where Instagram and Facebook need to get their stuff together, because it's just horrible. You have scammers, and I've had people clone my account. It's not nice. Now, forget about cloning your account. They hack your account, which is an account that you use to raise awareness of your daughter's cystic fibrosis. They hack the account, and then they try to essentially scam people and get people into a Bitcoin scam. It's so bad. It is so, 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 so bad. And it's probably the video with the most important message, and it got the least amount of views out of everything that I make. I wish I made it a bit more clickbaity. I know it would have annoyed people if I said, using cystic fibrosis to make 10 grand. Yeah, then it will have like 4,000 views on it. But no, because it's not that clickbaity, not that many people have watched. But thank you for asking, mate. At the minute, they've still got the account. They're posting. I posted yesterday some of the things that they put out on stories. It's disgraceful. I don't know where these people are, mate. But it's horrible. It's really, really horrible. And the thing is, she now has to contend with the fact that her old account, which she can't get access to and she can't contact Instagram about, These people have complete and utter control of that and continue to use images of her little girl, to get sympathy so that they can drag people into a Bitcoin scam. It is absolutely disgusting. It really, really is. Have you heard of the Fidelity Index US Fund? It's very low fee index fund tracking the S&P 500. Are flexible, highly rated in your opinion? Yeah, Fidelity are very, very good. They're really, 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 really good as a firm. They're probably up there. So in the brackets of like investment houses that are pretty good, you've also got Vanguard. Well, Vanguard, they are investment house, but they're not the same as the likes of Vanguard, of Fidelity. But you've also got people like BlackRock in there, which do the iShares. There's a ton of them, mate. But yeah, Vanguard are well up there. Oh, listen, you're gonna rope me into my favorite stock. I've actually taken profits on my Tesla. Like I said in the video from last Tuesday, for me, I have to look at the market situation right now in context to what some of my goals are. So with moving away in 18 months, 24 months time, I can't afford to sit on a portion of my portfolio and potentially have it be at the mercy of a market correction where it may take 5 years to recover. I know that we're 18 months, 2 years really within our timeline towards our plan. So I've taken some profit on my Tesla stock and some other stuff as well. But Tesla, I mean, look, the stock price fell last week because of supply bottlenecks, essentially. See, this is the thing about Tesla, right? So if you go back to last year, we all know that chip shortage has been a massive issue for the car industry altogether. The great thing about Tesla is the fact that you've got Elon at the helm. So where they've needed chips to do certain things and there's a shortage in it, in the chip supply, what Elon asked the engineers to do was to essentially rewrite code to bypass the need for those chips. So that's kept the stock price quite buoyant because to a certain extent they've been impacted, but they've not really been as severely as impacted as some of the other companies that don't necessarily have tech and software at the core of their product offering, like Tesla do. So I think in 2022, if you look at the car sales are ramping up. The company's becoming increasingly more profitable. Yes, supply chain may impact production numbers, may then impact car sales, but I don't think it's going to impact them disproportionately in comparison to their competitors. So I think for 2022, for me, nothing changes with Tesla. They still have the march on the market in terms of first to the market. They've got themselves to the point where they have a very, very, very big advantage on the competition. Yes, there are. I read a lot of stuff and watch a lot of content when it comes to what's going on in the EV world. There was a piece, and I was going to do a video on it, but I was like, it's very, very in depth and it would be long, and people just wouldn't watch it, wouldn't find it interesting. But it was talking about how some of the latecomers to the EV race are not going to make it because of the issues with the raw materials for required for batteries. Now, Tesla don't rest on their laurels. They've been around for a while, so they're trying to develop solid state batteries and different compound solutions for more efficiency in batteries. There was a story about a company that managed to build a battery that had 700-mile range, 700 or 800-mile range on one charge. Tesla's already trying to scoop them up. I don't know if anyone read this week, there was apparently a lithium deposit found in Cornwall. I don't know whether this is just spam or not, but it came across my feed day before yesterday. Tesla's already on that pretty much, and there's talk of potential Geiger factory manufacturing batteries. So Tesla got a huge margin. I don't think there's anything potentially from a fundamental point of view that will challenge or that will necessarily change the outlook for the business. I think the only thing that could potentially impact them quite significantly will be supply chain. It will be if there's any slowdown in the economy. Are people really going to be buying cars? Probably not. But then if it impacts them, it's going to impact the car industry as a whole. So I'm still very, very bullish on Tesla. I think the business has got legs. And we're seeing it now. What's it? I think it was $800 something the last time I checked, so a little bit off the high. But I think it's going to be a really good year for them still because they're making huge stride. And we've not even talked about the 25K car, which they're now pushing back. I mean, the Model 3 is already the most popular EV being sold in the UK and across many global territories. You bring in the 25K car as well, then all of a sudden you're going to have a massive lion share across multiple categories of the car market. And we haven't even spoken about the Roadster 2. We've not even spoken about the Cybertruck. We've not even brought into the equation their massive electric lorry either. None of those have actually come to market just yet. So for me, I'm still 100% bullish on Tesla. All right, let's have a look at this from Ola. Question 1: why is TR for certain oil ETFs or ETCs high? iShares, US gas and oil exploration ETF. The reason why the TR, so that's the total expense ratio, is because if you're looking at oil and or looking at gas, then oftentimes they will add in things like storage fees, because it has to be the oil will be stored somewhere. So all of those fees will have to be incorporated in, which is why you're seeing the total expense ratio so high for things like oil and gas. You're going to have service charges and stuff like that, which is what storage fees essentially are. Isn't this the question of the century? Look, mate. Look, that is a much bigger question, which I'm not really sure we actually have time for on this channel. Look, I think there are a lot of cultural things that lead into this question, and I'm certainly an example. I understand those cultural issues very well. Um, we have to get past a lot of those things. There is so much, mate, that I could unpack in that question. I could talk about that for an hour or so. It's something I'm actually very passionate about, because I think ultimately, we talk about social social economics and social groups, right? Being able to move through social demographics and that social mobility. There is work to be done in that space in answering this question. Then you get into education, know-how, skill set, accessing jobs, skill set around that, and just general mentality. Then culture. You mix that into this question right here. There's a lot to unpack. All right, started investing last October and invested a lump sum at the beginning of January, and now the markets are where we know how to deal with it. Looking for 15 years plus investing. Okay, look, mate. So you're probably like one of the people that I've just described earlier. This will be your first rodeo with a market correction. You're probably looking at it thinking, "What did I do the right thing?" Look, the best thing I'd say for you is if you've got a 15-year investment time horizon, you're in like the first 3, 4 months, 5 months of your journey, mate. You've literally just started out. If you were going on a journey from here to, I don't know, Germany, for example, right, and you broke down, let's say, 20 miles from your home, right, and you know that you needed to get to Germany, you absolutely need to get to Germany. You broke down 20 miles from your home, and it could be something very minor, right? Just flat tire. You'll just change the tire, you'll keep going. It's exactly the same thing with this, mate. This is literally just a bump in the road. In the scheme of your 15-year journey, it's nothing. And the great thing about this, and I will illustrate this so that you can actually see what I'm talking about here. Right, let me just get this up. So with you've got a 15-year time horizon, right? Year one. And you're here. You are literally right here. You've got all of this time to go between here. Now, the beauty of where we are right now for you is you've started to invest and buy the market when the market's in a little bit of a downturn. Now, if you bought in August, the markets, let's just say hypothetically, would have been up here, right? So you would have been up here. You're probably seeing the markets right now trail down, right? And this is where we might be right now. Now, if the market does continue to like trail off, And I don't know whether you're investing on the monthly basis, but if you are, then you potentially can have the benefit of actually buying into the market at lower prices. Because it doesn't really matter if the market goes all the way down here. You've got a 15-year time horizon. As long as the markets end up higher than you actually bought them here, get another color here. As long as your valuation or your entry point is lower than when you end up in 15 years' time, it's all good. This is completely irrelevant to a certain extent. And I know that that sounds really funny to say, but it is. From the volatility point of view, especially if you're not investing on a monthly basis, does not matter. If you're investing on a monthly basis as well, so let's just say you're throwing in 50 quid, you're picking up this unit here, and let's just say the market comes all the way down here, and you're buying all the way up here, even better, because you put in a lump sum at this point, but you might have got some units at a discount here, and you're just buying on a discount, and it will just be rising all the way through. It's a 15-year time plan, mate. I know that it will be really, really painful as we are here right now in January, about to go into February, and maybe you might be down a little bit. I know that that is really, really painful, but in the scheme of things, you've got 15 years. And over the long term, we know that the markets return very, very well over 15 years. And, this is part of the journey. This is kind of like, having a flat tire 20 miles from your house after you left. You're still on road to your destination. What happens between now and your 15-year time horizon when you're looking to get out, to a certain extent, is irrelevant. This kind of stuff will happen. We're going to be here again. It might be in 3 years' time when the market comes back down here. It doesn't matter. What you could do, though, and again, I encourage people to do this, if you are reviewing your investments on a regular basis, and again, you need to kind of know what you're doing here, but in simple words, if at the end of year one, right, so we're in, 2022 right now, let's say you get to 2023, and let's just say your investments are here. Review it, see how you're feeling. Do you need to change your strategy? Do you need to change what you're invested in? Do you need to, I don't know, move from, I say, less equity into more safer assets? This is your journey. You get to decide what you do. Yes, logic says that because you're investing for 15 years, you should be taking more risk. But ultimately, it is about making sure that you are comfortable with the level of risk that you take. And you never want to overextend yourself on the risk, because one of the key things to remember when you're investing is to protect your downside. You always want to protect the downside at all cost. If you can protect your downside while speculating for the upside, that's prudent investing. It's not going into things, oh my God, I hope, we're at this point right now, in 15 years' time, it's going to be here, and hoping for the best. No, it's risk management. It's trying to be as cognizant of as possible around, okay, so what are the risks that I face? What are the potential things that could mean that over the next 15 years, I might not get to my target? And, let's be completely honest, right? We're here right now, and I've just drawn this saying you'll be here. Let's just say you get to year 13, and all of a sudden, we get another market crash. What are we doing? We get another market crash, and it goes here. If that's year 13, then you absolutely need to be reevaluating your investment to say, actually, I'm 2 years to my goal. Do I take profits here to ensure that happening doesn't wipe me out and mean that the preceding 13 years was a complete and utter waste of time? Now, typically, a financial advisor will be doing all of this work for you. And this is where I talk about investing and the theory of investing. And people feel as though there's not a lot to it. There is a lot that goes to it. The fundamental principles are very, very simple. The fundamental principles around what level of risk you take, that's very, very easy for you to understand. But your journey is your journey. At every single juncture, at least once a year, you should be reviewing your investments. You should be asking, right, how did it do? Did it perform positively? Did it perform negatively? If it performed positively, okay, why? If it performed negatively, then why did it perform negatively? Was it just the fund that you were invested in that performed really, really badly? Was it the VUSA because that's what you chose? Or was it more of a global market event that meant that everything's down and everyone's kind of in the same boat? If it is the fact that actually it's just this fund that performed badly, then you may need to reconsider and be like, okay, is there something else that I could go into that I could compare it with that might have a better makeup for what I'm hoping will come around the corner? Now, obviously, you don't know what's going to happen in the future, but it's trying to take a pragmatic approach and reviewing every single year, because I've advised clients before where they say my goal is 15 years for here, but actually you realize because the markets have been so kind over a period of time that actually the goal that they had here is met at year 12. And it basically means that you don't have to be invested for the remaining 3 years. You can literally take your money and use that for your goal at year 12. But you're never going to know whether you're on track to your goal if you don't review it every single year. You have to review your investment. So you're very much at the beginning right now. Don't worry about what's already happened, but keep an eye on the markets. Make sure that obviously you're comfortable with what you're invested in. Make sure that you're not overextended. If you're happy with everything that you've got as it currently sits, then look, just leave it. Come August 2022, you then pick it up and say, right, from a 12-month snapshot, am I in good shape? Has it performed as well as I should have, as well as I thought it would? If it hasn't, okay, do I need to move anything? If it has, fantastic. Is it still the right place for me to be invested? Or do I want to maybe move it into different things because you noticed during the downturn that actually there was something else that you could have been invested in that wouldn't have had the same impact, or evidence shows that a certain market wasn't impacted because of certain things? It's a learning. And again, if you don't know what to look for in those learnings, the question then becomes, should you be picking your own vehicles if you haven't enlisted the help of somebody to do it for you? So that's a very, very long-winded question, mate, but answer. But mate, 15 years is a very, very long time. Don't worry about what's happened right now. The markets will recover. This comes with the territory. This is what investing is all about. Okay. Hopefully you've taken the right approach in terms of making sure that you're comfortable with the level of risk that you've taken. Hopefully you've got an emergency fund. Hopefully you've got all of your foundationary stuff in place. But 15 years, mate, is a very, very long time. The only thing that I'll be asking you to do is, yes, pay attention to the markets, keep an eye on the market. When you get to August, your anniversary, maybe just have a look at where you are. Just, see, has it performed as well as you had hoped it would? Has it performed in line with other things that you can kind of see within the market, other similar funds? That's really what I would say. But don't worry about it for the time being. Don't panic for the time being. 15 years is still a very, very long time. Do I provide any trading on options trading? I use Plus 500 at the platform in the UK. No, I don't. That is not my area of expertise. So it's not something that I can really comment on, if I'm completely honest. People do ask me this all the time. It's not something that I do. It's a completely different game. It's not investing, it's trading. And if you're trading on options, you really need to know what you're doing. You need to have an eye for markets and patterns and analysis and all that kind of stuff. And I know quite a bit about it, but not enough to be giving instructions or coaching people or providing any kind of insights into that type of stuff. I generally don't like talking about things that I'm not 100% okay with. I think that's very, very important. I mean, I talk a bit about crypto, not as much as I should, because if I'm completely honest, I'm still coming to grips with things like crypto myself. So that's why I have someone like Radic on, who is managing, a crypto portfolio for his copiers on eToro. He's in this day in, day out. He looks at analysis. He looks at, what's going on in the markets and all that kind of stuff. I'd rather have him come on and have a say in, what's going on at the market to answer these questions that you guys might have more eloquently than I can. And options trading is exactly the same thing. The thing is, I would invite someone on to talk about options trading, but I don't know of any that I 100% trust are legit to come onto the channel. If I do find one, though, I will have one on for sure. For sure. Have I seen or used an investment app called Lightyear? I do recall the name Lightyear. I'm sure they reached out to me last year to do a review, and I didn't in the end. I said no. I can't remember why I said no. I get so many approaches to review apps and all this kind of stuff. Um, but yeah, I don't know. I don't tend to just promote any kind of app. I want them to have a little bit of a track record. If they're just starting up, it's like, well, you may not be here in like 3 months' time or 6 months' time. So I tend not to. But I have heard of Lightyear, but I've never used them. Bear me 1 second, guys. I'm just scrolling the questions. I'm just conscious on time as well. I'm from Belgium. Want to start investing? Do you know a good investing app? I heard Trading 212 will start on board in Belgian citizens soon. Is it still good, or would you advise another app? Belgium, Belgium. I thought Trading 212 onboarding customers in Europe anyway. So you might want to check if they're not onboarding already. I mean, they are very, very good. Don't get me wrong. They are very, very good. Just make sure that obviously you're okay with all the T's and C's. They've had a lot of changes on the T's and C's, but to be honest, there's nothing you can do about that. But just make sure you're happy with those. The other one that I know that is available within Europe is probably eToro. eToro will be the one to use as well. You can't access. They're not set up the same as Trading 212. So yeah, you can access individual stocks, you can access crypto there, you can access ETFs, but it's not the same as Trading 212. Trading 212 is easier to use. It's a friendlier, I guess, user interface than eToro, really. But yeah, eToro will probably be the best one for you to have a look at because I know that they are all over Europe. They probably got the widest coverage when it comes to investment apps that are out there. If you want to use, actually, they're not in my descriptions anymore because I've taken out all of my investment app links to the 2022 videos. They might go back a bit later on, but if you go back on some of my old videos, you'll see a link to eToro there. So if you've not got an account, you could use that if you want to as well. Cheers. Which high potential growth dividend paying stocks would you recommend long term that you have your eye on? I don't have my eye on any high yield dividend stocks because dividends are, in my opinion, overrated. And I know that would be a very, very big surprise to a lot of people who watch me. But I see way too many YouTubers talking about dividends, 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 dividends. It's like I have this. I'm doing my dividends update report, and it's like you got 25p dividends, mate. That's not going to do much good, is it? Like dividends are great. I tend to, as an investor, focus on total return, which will include share price appreciation alongside dividend payments. I mean, there's a conversation we can have about dividends that on its own. Dividends essentially takes value from the share price because you're paying out from the profits, which can have an impact on the share price itself. It's not my main criteria for picking for stocks the way I'm invested currently. Because if I'm looking to invest for growth, then the dividend factor is completely and utterly irrelevant. Because if you only filter it by the lens of dividend paying companies, if you're looking for growth, you're looking to grow a portfolio, then say goodbye to the likes of Amazon, Tesla, and some of the big companies that have really driven stock market returns over the last 24 to 36 months. A lot of the big companies that have performed extremely well don't pay dividends, just don't. So if your lens is selection because of dividend payments only, you're going to miss a lot of companies. So I focus on total return as an investor. Good companies, if I'm picking individual stocks that have good future plans. If they happen to pay dividends, happy days. I will look at dividend stocks if, for example, I'm looking at, want to build a portfolio. I've got to change my battery. If I'm looking at a portfolio, looking to build a portfolio that needs some security, some foundational stocks, then dividend paying companies will actually really, really benefit you in that kind of equation. But I don't necessarily invest purely for dividends. And like I said before, I'm not going to sit here and say, right, these are the dividend stocks that I have on my radar because they may not necessarily be the right picks for anyone who watches this, who's looking to invest, not really understanding what dividend stocks are really all about and how dividend stocks really, really work. I'm just scrolling here, guys. 1 second. Free trade fees may be a little high as a monthly recurring, but the UI and support needed provided by the team. I'm thinking I may be investing next 40-year minimum. Gonna feel if the cap up. Look, free trade are really really good. It's not one that I use myself, but like I know for a fact that customer service is really 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 good. I mean, I've heard it from people, and I've actually tested them out. They're very very good in terms of the customer service, and this is the kind of stuff that we're talking about, right? Cost is only an issue in the absence of value. So yes, you're paying them a fee, but can you get hold of them if you need them? There's nothing worse than you using an app or a service, but when you need to speak to somebody, you can't speak to anyone. If they're charging you a fee to be able to pay for staff that can pick up the phone to you or answer your questions, then that's all part and parcel of it. That's part of what you're paying for. I use again Money Farm as an example. Like I don't need it. But if I ever needed to ask somebody a question, in fact, I had an email last year, like literally last week. Someone was sent me a summary of the last 12 months and my investment journey, like in my account, how it's performed, what they basically did over the last 12 months. And if I wanted to speak to somebody, I could go into the app and go and book an appointment for Tuesday, 12 o'clock, and speak to one of their guys who can talk me through my portfolio, and I can ask them any question that I want. I'm paying them a fee to manage my investment and give me access to somebody so I can actually speak to somebody and ask a question. If those are the kind of things that you value as a potential investor where you don't want to be left on your own, then these fees they're appropriate. It's what value do you get from it? What are you paying for exactly? Like I said, free trade, yeah, you've got to pay £3 a month for the ISA. You've got to pay $9.99 in order to have access to all of the investment instruments that they have. But if they're providing you a really really nice service, then is it worth it? I would argue that it is, because keeping costs down just to make sure that you can keep obviously the returns as high as possible, which is great. But if you ever need help and you're stuck, you've got nowhere to go. What's the point? Yeah, that's just a follow up on that. Yeah, and Ned was just saying here that they value fees as I think I know what I'm doing. Yes, exactly, mate. So Ned, where you kind of know exactly what you're doing, you may not actually need the help of these companies doing some things that you probably know how to look for yourself, and that's the whole point. There are way too many. I talk about content and context all the time. There's a lot of content here, but there's not a lot of context. Context is so important. The devil is in the detail a lot of the time. So understanding, right, where am I? What's the best choice for me? That's really what it's all about, because it's personal finance. It's personal to you. You've got to make the decision. You've got to be comfortable with that decision. There's no point in making a decision that you're going to be second guessing yourself on. So the function, the way I see my function here on the channel on YouTube is to basically provide context so people can say, actually, you know what? Based on my certain circumstances, these are the things that I want to consider. Therefore, I'm going to make this decision. And you almost have like a decision tree that you go down. It's really, really important. Carly's on here. How you doing, Carly? Oh, this is interesting. You've been using Anchor Protocol for 19.5 USDT, no lockup, and also Hotbit for 12%, 90-day lockup, 19.5 USD. Oh, no, okay. I might need to have a look into this. Cheers for that, AA. I might have a look into that. Cheers, Kev. Appreciate that, mate. Thank you very much. And by the way, guys, I this hasn't gone unnoticed, by the way, but at one point we were at like 80 people or so on here, and week on week this is now going up. I want to get to the point where we have, in the height of the pandemic, I remember having a live on where I think we had 220 people on, which is pretty good. So if over the next couple of weeks we can get to 100 plus and keep it sustaining and keep it growing, then that makes it really really worthwhile for me, like doing this on a weekly basis. But yeah, appreciate that, mate. Thank you. And if you've not already smashed the like button already, please do smash the like button. Naeem, what's going on? Far in the future, this question is, but will you continue to create content once you settle abroad in Dubai? Correct. No, no, no. Listen, I am definitely. I think for me, like if I had a job, like if I had like an office job or a full time job, I wouldn't be able to even be thinking about going to Dubai. But the beauty of it is because this is online, I can do this from anywhere. I mean, it's a 4 hour time difference, so they're 4 hours ahead. So it will just mean that I have to adjust my upload schedule. Maybe the times of these lives will have to be different, but I will be doing content from out there. And I think it will be a little bit more interesting in terms of content because there's so much more that I can get up to out there as well from a business and even just, just general aesthetic point of view. Imagine like I want to do, I've got so many ideas of content I want to create, but sometimes weather doesn't work too well or other things that I've got to do, and it will just be a completely different scenario out there. So yeah, I'll still be creating videos here on the channel, still be holding these lives even when I'm out there. Oh, this is an interesting one, Jeff. They just signed a deal with Panasonic to produce batteries to help with supply. They said they got more demand than they can supply currently. I watched the earnings report. Yeah, I mean, look, Tesla aren't messing about, me, and I think yes, competition is is needed, and competition is coming. Competition is already here, to be honest, for Tesla, but that's only going to make them stride even further. And I watched a video today, right, of their latest beta for their autopilot. It is phenomenal. This thing navigating busy traffic with traffic lights and traffic, doing like a turn through a junction, didn't miss a beat. Did not miss a beat. These other companies are way, 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 way behind. They are way, way behind where Tesla is right now. And believe me, everyone's talking about where like catching up with Tesla now. I guarantee you, because Elon is the way Elon is, he's already thinking 5, 10 years in advance right now. Already. And if he's not already building these things into the cars already, I'll be very, very surprised. So there, look, I'm very, very bullish on Tesla, as you guys probably already know. Unfortunately, I am going to run my Tesla into the ground until it does not work anymore because I cannot justify spending any money on a car right now. But when that finally does happen, I mean, just looking at the new Model S, Jesus Christ, I actually know someone who's actually ordered one. One of my mates has ordered one. It won't arrive until back end of this year, beginning of 2023. But I cannot wait to see that thing. I mean, just the design aspect, the interior, like improvements that they've made, is strides from the one that I've got right now. I'm told it feels a lot different. I've watched videos of it. It feels a lot different. And because they're always forward thinking, I'm just very, very excited about the company and what they're going to do. And just Elon, I can't wait. If Starlink goes to IPO this year, oh my God. It gets me excited. It really, really does. But there you go. So Jeff is saying here, expanded in the Chinese factory. Geiger, Germany's not even he's not even ready yet. He's going to go soon. Texas, look, mate. We can talk about Tesla all day. Competition. I honestly, other companies have not got a chance just yet to be able to beat them. They may come close, but I don't think they'll. In my opinion, I don't think Tesla will lose market ground in the way a lot of people believe that they will. I just don't see it, honestly. Let's have a look at this one. How about demystifying investing to our young people? Would you talk at schools? I've done it. I've done it very rewarding. Yes, I do speak at schools. I've spoken at a handful of schools in London. I've actually got an event coming up in March for one that I spoke at last year. We're going to actually do a day where it's for the family, for the parents and the kids. So we haven't firmed down the agenda just yet, but my thinking is we're going to start with some of the foundational stuff like the day-to-day money budgeting, that kind of thing, and then really do an expose, I guess would be the word I'd use, for the markets and how wealth has been generated and has been created using the stock market for years, and why it's so important that at a young age we understand how the stock market works, because when I was in my 20s, and this is the reason why I made this channel, is I wish that someone had a conversation with me when I was in my 20s to say there is such a thing called the stock market, and if you put money into it on a monthly basis, on a regular basis, and wait over the long term, it's going to give you a pot of money in the future, which will give you options. Those are the kind of conversations that I think are really, really important for kids in schools. And yes, the foundational subject around budgeting, and particularly now around social media, consumerism, and this incessant need to want to fit into a box and keep up with the Joneses. Those kind of things need to be taught in school, but in a relatable way that puts it into context so that the kids can understand it. So yeah, I do some talks. If you know of any schools that want that kind of talk as well, just let me know. If you ping me a message on IG, or just email me at pete@conversationofmoney.com, then yeah, I'll be more than happy to do some talks. But yeah, that's one of the things that I'm really, really passionate about. I'm looking at doing a project here in the Midlands, where we can actually put on an afternoon for families and young kids, teach them about investing, entrepreneurship, getting into corporate jobs, career progression, that kind of stuff. I can bring on board. I can bring on board entrepreneurs. I can bring on board investment professionals. I can bring on board recruitment specialists, HR experts. I'm looking to do that locally in Birmingham because I live up in the Midlands at the moment. We're looking at hopefully trying to do something like that in the summer to test, to see if we can make that work and possibly roll it out across other parts of the country. But yeah, I'm really passionate about that type of work. But it's a lot of work that goes into building that as a program. This is interesting. Where should a 45-year-old woman with no pension be looking for one that is flexible with self-employed earnings? Okay, so really, really good question. So if you've had no other pensions before, you're going to want a provider that will allow you to pay into the pension as and when you want to. So if you're self-employed at the moment, I don't know whether you're a limited company or a sole trader. If you're a limited company, there is benefits in you using the company setup to pay into your pensions, because then it becomes an allowable expense, and you can use it to offset your what's it called, your corporation tax. So providers, I'm only going to use this provider because I host their podcast. I've got my pension with them. They are very, 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 very good. Pension B, fully flexible. If you can only commit to opening up with £1, you can open up with £1. If you want to commit to, I don't know, putting in £10 a month, put in £10 a month. If you want it to be more sporadic, so you put in £10 a month 1 month, and then you put in 600 quid 6 months later or a year later, completely and utterly flexible. So pension B would be the one that I would say would be the one that will work really, 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 really well in that regard, because they are fully flexible and they work very, very well with self-employed people. I've got a portion of my old pensions with them that I consolidated year before last. Very, very good. Errol, is it best to invest and overpay into a civil service additional pension added years to take out a SIPP or a stocks and shares ISA? If you've got a civil service pension, you have a guaranteed pension. Okay, so they're very, very rare to come by. Really, because there are an element of guarantees in there, you should definitely have a look at perhaps paying into your civil service pension. But I can't tell you what the best route is going to be without actually knowing what you actually have and what part of the civil service you're essentially in. But the main thing I can tell you is this, right? Just for you to understand your train of thought on this. Civil service pensions will have guaranteed pensions when you retire. So that will be guaranteed for life, linked to inflation, unless they change that in the rules. But guaranteed pension. If you pay into a SIPP or a stocks and shares ISA, well, you're paying into this thing. You're hoping it's going to appreciate in value. There is no guarantee around the money that you're going to receive in pension income from it. So the civil service arrangement that you're in will have a distinct advantage because of that specifically. I think it's worthwhile you sitting down with, your employer, finding a little bit more information about the civil service pension itself, maybe do a little bit of reading on that so you can kind of understand how it works, and make a decision from there. But you have a distinct advantage on a civil service pension than just a SIP, stocks and shares ISA. That doesn't mean that it completely rules it out, but because you've got guarantees on the civil service, have a look at that first. I know you've got a follow up here. Could you look into this public servants? See, the thing is, like, without the detail, and a lot of them can be very, very intricate in terms of how they actually work, particularly if you've been there for a very, very long time. So, really, in order to do a comparison, you need a financial advisor. You need a financial advisor because you want to make sure that you're going to be in a position where you can make the right decision based on the analysis of what you're in currently versus where you might go and what that picture, if you forward forecast and forward plan that payment into a SIP or into an ISA, what you want to end up with is essentially a hypothetical, well, partly hypothetical comparison between, right, we know your civil service pension is going to pay out this. If you put in money into a stocks and shares ISA or a pension and you forecast it for the next, I don't know, 15 years, whatever your retirement timeline is, this is what the situation is. You need a comparison between the two. And you have to see a financial advisor for that, unfortunately. It's not something I can do within coaching. If you don't know of a financial advisor, I know a few that are very, 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 very good. I can introduce you. But yeah, you want to speak to a financial advisor really because you want to have a tangible analysis and a comparison between the choices that you're going to be faced with. Again, it may make sense to utilize an ISA, but because you have the guarantees in there, you need to consider the guarantees first and foremost. Really, 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 really important. You have to consider the guarantees first before you make any decision. How would you go about starting at 18 years old with Hargreaves Lansdown? Look, mate, go on to Hargreaves Lansdown. I mean, look, bear in mind with Hargreaves Lansdown, there are fees, so make sure you're comfortable with the fees. And I did speak about the fees not being a big issue, and obviously something that you should consider. But you want to know what fees you are going to be paying if you're going to use them. But look at things like ISAs, tax efficiency first. Have a look at ISAs. They've got a lot of investment options within there. They're kind of like a supermarket. So you'll have Vanguard stuff in there. You'll have Fidelity, BlackRock. You have a whole host of fund providers there. So just do a really, really nice recce around the website to try and pick what you want. But ISA first and foremost, because within an ISA, most of it is going to be tax free. So just be mindful of that. False, mate. Listen, oh dear. I've been in Teslas that have got AP2, the autopilot 2, and that's sometimes it freaks you out, and sometimes I've been in one where it almost killed me once. But that's the whole point, right? Autopilot is not fully autonomous, and you're supposed to pay attention, which is why it baffles me when there's an accident because the car was on autopilot. Then it turns out the dude was in like the passenger seat. It's like it's not fully autonomous. You get told this when you buy the car. The car warns you when you haven't had your hands on the steering wheel for an extended period of time. It beeps at you like profusely, like really, really loudly. And yeah, but the full self-driving, I've not quite experienced that just yet. But just some of the stuff that I've been watching on it, it's amazing. It's really, really, really amazing. But Starlink, yeah, I'm very, very excited about Starlink. Yeah, they took a position in there. So if you want coverage, Google has a slice before it goes. You know what? It's always going to go to big companies. And to be fair, though, you would expect people like Google to try and get in with that kind of stuff. I mean, what he's doing there is just it's going to like imagine in 2022 being able to go to locations and have no Wi-Fi. Like it's 2022. And the mad scientist Elon is, he thinks, you know what, this is absolutely ridiculous. That should be very, very easy. What's the solution? Well, it's a bit out of this world, quite literally. Yeah, we can do that. He's got a can do attitude. That's why you've got to love that guy. Like, talk about a mad scientist. He's just a pioneer in his thinking. Like, whoever thought that rockets, spaceships could be reusable? Like, we laughed out the room like 30 odd years ago when they were developing, the space shuttle. We laughed out a room. Reusable. How are you going to make it reusable? What does he do? He makes it reusable. It's like you just cannot. It's pioneering, absolutely pioneering. I watched an interview with him talking about Neuralink, and that's another company again that, if that ever goes public, it'd be amazing. He's saying, chips now, they are at the phase where they're going to start human clinical trials, and this is going to be groundbreaking. Like, you can put a chip in the head and it will cure blindness, deafness. It is absolutely insane what this guy is doing. And again, you think about people who may and have the potential to be trillionaires. I mean, he's already a billionaire. Elon is probably that guy, because if you think about all of his ventures, Tesla, is it fully matured? Probably not. With Tesla, we've also got Solar City. Then you've got the likes of Starlink. Then you've got Neuralink. You've got the Boring Company. And God knows whatever else he might actually think up. So, he's amazing. I mean, very, very excited if Starlink goes public this year. Carly, would you jump into an IPO though, or just wait for the big boys to exit? Well, if you're looking at Starlink, I would probably jump in day one. The reason why I'd say that is because, look, if it depends on what my goal would be. If I was going to be day trading it, I think there'll be good profit to make on day one if you position yourself right, because the volumes on that. Imagine Starlink going live tomorrow. The volumes are going to be humongous. So if you position yourself, you could potentially do really, really well. But I would go in to hold for the long term, because, like, literally, it's world changing stuff. It really, really is. And then the contracts that come off the back of it, the price, it will do extremely well. So I would probably go in day one. I would go in day one with something like Starlink. I'd try and get in day one and just hold. And if I was day trading, try and position myself on the day where I could at least cream some fat on that initial bump on the price. You were saying SpaceX, not Starlink. Yeah, makes sense. Is Starlink going public as a separate entity to SpaceX as a whole? Because SpaceX is a private company, because what they're doing with starships at the moment isn't exactly profitable. Yeah, I think it's, from what I read, it was going to be put out on the market as an IPO as a separate entity to SpaceX, is what I read. But who knows? Those plans might change. I mean, at the moment, this is all speculation, right? So it may turn out that if it does IPO, the plans might completely change. It might be in conjunction with SpaceX and so on and so forth. So who knows? Does being a woman affect that? Let me see if I can. About pensions. Okay, good question. No, it doesn't. No. So it doesn't matter whether you're a businesswoman or a businessman. The pension rules are the same across the board, essentially. So the principles are still fundamentally the same, regardless of whether you're a man or a woman. So yeah, I mean, look, if you're looking at certain elements, I think what you're alluding to there is some other stuff that was in the news around state pension. State pension age is different between man and woman, so you'll have that as a consideration in terms of when you have access to the state pension. But fundamentally, if you're paying into a pension, the rules are exactly the same. The state pension side, though, you'll be able to access at different ages. I'm just scrolling through, guys. I'm really conscious of time. We're an hour 37 in, so I might try and pick maybe one or two more and get through those. And then we can continue this next week for any ones that I did not get to answer. Let's answer this one, because this is a pension job. Can you have a pension with your current job and a private pension, like Pension B for pensions you have accumulated over the years? Yes, you can. There's nothing wrong with that at all. So if you worked at 4 to 5 different places before, you want to put them all into one place, yes, you can. You can do that. That's kind of what I did. because when I transferred, I was still working for a discretionary fund manager. So I transferred pensions from like 4 other places that I'd worked previously into the one pot with Pension B, then still had my workplace pension with the discretionary fund manager, which I later then moved over to Pension B. So I've now got 5 or 6 in one place altogether. Yes, that's what I was alluding to there. Your state pension age will be different depending on male or female. I can't remember the ages specifically right now. I think it was either 68 and 66. I'll have to double check that to be sure. But yeah, the state pension age is different. So the point at which you can access a state pension will be different. All right. Okay. Cool. I think we've come to the end. I'm just trying to look and see. Yeah, mate, we could talk about Tesla and SpaceX and all the stuff that they're going through. We could be here for another hour and a half just shooting on that stuff. But cool. I think I've managed to get to the bottom of that list right there. Thank you so much for joining me. It's 10:30. I know that a couple of people have said that maybe 8, half 8, maybe 9 o'clock start will be better for these kind of things on the Sunday. I will run a poll in the community section. So if you can just give me your opinion there, that will be great. If the consensus is you'd rather have an earlier start, then we can do that. To be honest, it will probably help me a little bit more because oftentimes I work all the way up to 9 o'clock to do this. Then sometimes I have things that I need to finish off after these kind of lives for the podcast and things the following week. So starting a little bit earlier may actually benefit me as well. But let me know in the community section. I'll post it not tonight. It'll probably be tomorrow or through the week. Let me know what time you want these, and we can reschedule the time if it comes out as something that you guys would prefer. But yeah, thank you guys for being here, and thank you for obviously supporting the channel and everything like that. February gets a little bit busy, so the videos will look very different through Feb as I start shooting for Channel 4. So yeah, just a heads up for those of you who are regulars here. The videos may be a little bit run and gun, different feel, but we'll get through that and then we'll get back to normal programming. I would say maybe through mid-March, back end of March. But yeah, thank you guys for being here. Have a good week and a good evening, whatever it is that you decide to do for the rest of the evening. Thank you guys. Catch you in a bit.